Welcome to Better System Trader, the show where we talk about all things systematic and algorithmic trading. And today we've got a very special guest. I've been looking forward to this one for quite a while now. Mish from marketgauge. Welcome, Mish. How are you?
I'm great. How are you, Andrew?
I'm very well, thank you. And now I've been looking forward to this for probably a couple of months now because you were a guest on our trading panel that we did. I did a couple of months ago with Jason, and I really enjoyed what you had to say, and I've been following your work and researching you for quite a while now. So it's really an honor to have you on the show here today. Thank you.
Well, thank you for having me. It's an honor to be here.
Well, before we dig into what I think is one of your superpowers in trading, can you give us a little bit of background on yourself just to give some context to our discussion today?
Okay. Well, as we say in the States, the Reader's Digest version is that I grew up never thinking about finance or the markets because we were sort of a working family, and my goal was to be a teacher. And so I did become a teacher, and actually a special education teacher, but I quickly evolved into more administration in that I became a consultant for school districts and for individual kids, placing them in general education. So that was my thing, was to rid the school systems of exclusion of kids with disabilities. And it's a fight that many people still continue to battle, and that's a whole other story. But when I did everything that my family expected me to do, I got married, I became a teacher, I lived close to my parents, and then when I was in my young 20s, I said, okay, I don't really want to be married to this person. I don't really want to be living in Queens, New York, which is close to where my parents were. But I still didn't mind the teaching until I got divorced, moved to Manhattan, realized I couldn't afford to eat on a teacher's salary. And then it was just, basically kismet. This woman that lived in my building knocked on my door one day. Turned out she was a clerk for Merrill Lynch on the Commodities Exchange in New York. We became friendly, and she said, hey, you want to come down and see where I work? And it was like, wow, this is what I was meant to do. And it wasn't easy, but I got a job down there, worked for Conti Commodities, became a broker in coffee, sugar, cocoa. They went belly up because of the Hunt brothers trying to corner the silver market back in the day. And that started my career as an independent. And I started getting seats around the exchanges, and I learned how to trade pretty much everything. And I mean, the only other thing I'll say about that is because of my physical difference in that I wasn't strong enough or loud enough, I often had to rely on anticipating what I wanted to do and giving somebody an order or jumping in before the insanity so that I wouldn't get all basically washed up and swallowed up by the sea of men. But I loved it. I loved every second of being down there. I was there for 14 years. And the other thing I didn't expect was to, Keith had left the floor by this point, and we met up in the World Trade Center, and we started dating. So it was kind of like another interesting kismet was that I would marry somebody who loved to trade. And so he's really been entrepreneurial with marketgauge. Well, before that, he had a company called Market Vision, and then DataView, and then marketgauge. And I started working with them, and here we are.
Excellent. Well, we're going to dig into, I've got a question towards the end I want to ask you about longevity in the market, because obviously from way back and, on the floor to what you're doing now, the markets or trading tends to have a high rate of attrition. So I'm going to ask you something about that later, so something to keep into the back of your mind. But how would you describe your trading approach today?
I've evolved so much. And what's so great about this business, Andrew, is that you never stop learning or evolving. Obviously, when I was much younger, especially on the floor, I was scalping because that's what you did back then. You would have a core position perhaps, but basically you were following momentum. So if the bids got louder and the orders came flowing in, you would get in there. And then as soon as you would feel things dry up, you'd get out. That's how I started, in and out, in and out, in and out. When I moved, when trading went from open outcry to electronic trading, of course, that's not so easy. There are people who still do that, but that wasn't for me. So I had to reinvent myself, and I became more of what I call a mini swing trader. So I would get a thought in my head about a position I wanted, but maybe I'd be at least taking a profit or out within 2-3 days. And I did that for years and years and years. And sometimes I would stay with something longer, but that was the average. And now that I am more mature, and I don't want to do that either. So I actually now do more swing trading. So I'll get my head behind something, whether it's a mega trend or a geopolitical situation or a consumer instinct about a company or a product. I will then time my way in using my technical analysis because I was a chartist on the floor. That's one of the things that I got really, really good at. And then I will sit now with things much longer with risk parameters. If something's not working, I'm not stubborn about it. I will get out.
Yeah. Yeah. Well, I agree that I do think that is one of your superpowers, being able to read the charts and read the markets. Now, you're on quite a few TV shows for your opinion on the markets and on lots of popular or very large YouTube channels for that exact skill. So I thought that might be a good topic for us to dive into today in techniques to read the markets. I think it's a super valuable skill, whether you're a discretionary trader or even if you're an algorithmic or quant-based trader, being able to understand the context of the markets and the context of the trades that you take can be incredibly important in the results that you achieve, right? So I saw a video that you published, I think it may have been a couple of years ago now, which I think was really had some really important points there. And that was about market phases. I think traders typically think, bull market, bear market, and that's kind of a binary look at the way things work. But you really talked about a number of different market phases and the transitions between those. Can you give us a little bit of insight into how you look at market phases?
Well, just to give you a little background, so I wasn't the only floor trader with marketgauge. Keith, obviously, he was a floor trader for many, many years. And so was Jeff Mish, who's the president of marketgauge. So we all were cut from the same mold. And as a result, what we know very well is that the definition of a bullish market and a bearish market is a little bit too constricting. And there's a lot of stuff and opportunity that happens in between whatever the classic definition. I know I see people say, something's up 20%, it's bullish market, something's down 20%, it's in a bearish market. And that doesn't fly as a floor trader because then you won't really be able to capitalize on every market condition. So what we discovered, and it's so simple, it's my book, actually, Andrew, Plant Your Money.
Oh, yes.
Yes. And every time I waver from it, I get into trouble. As soon as I stick to it, I do so much better. That's how simple and beautiful it is. So basically it's 6 phases, right? Using 2 simple moving averages. Now, that doesn't mean that I don't use other things at this point. I have learned momentum indicator is something that I'm really, really keen on these days. Another proprietary instrument, by the way, that marketgauge has, but we can get back to that. In terms of the phases, I use a 50 and a 200-day moving average. I may use a 10 for timing. There are other things that we may use on a much more shorter term basis, like a 1-minute chart. That's only to execute or to get stopped out. But in terms of my idea of what I want to get into, when I was more technical, I would just buy because something changed a phase. Now I like things more and I wait for the things that I like, but I still wait for them to change a phase. So the bullish phase and the 50 and the 200, and by the way, you can do this on a weekly basis too. So you can have a 50 week and a 200 week, which is what I have in my book. And the reason why is because it's a slower time frame. So I really love when both line up. But anyway, so if the 50 is above the 200, that's a bullish phase, especially if the price has to be above the bullish. And we have a wheel on our website that kind of shows you all of that so you can see. And what you really want to do is you want to be able to identify the transition of a phase. That's always the best time to get in because it's sometimes the most explosive, number one. And number two, it offers the least amount of risk. So trying to visualize this without having an actual visual in front of me. What happens is when the 50 is over the 200 and the price is above both, that's bullish. But sometimes, as we know, as markets start to correct, the price will go down below the 50. But the 50 is still above the 200. That's a caution phase. That's a very important phase because what that tells you is exactly that. It's why we call it caution. Some people call it warning. It literally means, maybe it's time to lighten up. Maybe things are shifting. Whatever, it's time for you to actually pay attention to something that maybe has been in a bullish phase for a while and now it's going to caution. I mean, we could use so many classic examples of the market right now if we had a lot of time, and I was actually doing a webinar, but essentially, like off the top of my head, let's just look at semiconductors, right? So if we went SMH, which was in a bullish phase for so long where the 50 was above the 200, I also like to use the slope because the more directional the slope is up, the more the momentum and the strength of that phase is. So we had this SMH dancing sometimes on the 50, but holding it, and then whammo, in the last several weeks, it broke the 50, gave people caution, people who knew how to pay attention. Then sometimes it goes back to a bullish. Sometimes it's just like a little story came out and it knocks out the weaker longs and it goes right back. That's fine. If you're really a long-term trader, you may ignore that little blip. But if you're a short-term trader, it's good information. You can actually get out, go short, and go back long. But if the price starts to break down under the 200-day moving average, that's the 50 and the 200 are still stacked, is the word we use, but the prices now fail. That's actually a distribution phase. So if you go from bullish to caution to distribution, that meaning is, okay, cash is starting to really come out of the market. Distribution really means the money is distributing out, maybe somewhere else, but that is irrelevant for this conversation. And that's often a very good time for people to exit. And that's really when you see a lot of institutions, sorry, the slamming, it's windy here in San Francisco. That's when you start to see institutional investors getting out of the market a lot, is when something breaks the 200-day moving average. So then the really question is how long period that happens. But eventually when the 50, if it lasts for a while, the 50 starts to break down under the 200, that's the classic death cross. And if the price is still underneath that, that's when we enter a bear phase. So that's going from the bullish to the bearish. But I want to take a breath here so you could say something. So it's not just me talking, and then we can go to the first side.
Okay, thanks. So in that case, then, if you are, say, a long only trader, maybe you only buy stocks and then you don't short them. How would those types of traders adjust the way they're trading in those three phases that you mentioned there?
Well, there's two ways they can adjust. Number one is they could obviously go to cash during those periods or wait for some kind of a correction, because no matter what phase you're in, you're always going to get short covering rallies in a down market. And those short recovering rallies, and I know you wanted to talk about reversals and things like that, there are other signs to look for it, even if it hasn't cleared the moving average. But very, very often you'll get a move at an oversold condition. Those moving averages become like a magnet, and you'll get a rally right up, back up to that moving average. And so if you like to go long, you might catch that move. But if it doesn't clear back over the moving average, that's it. Your move is over and you get out. That's one way. The other way to make money, if you're a long only type trader, is to find something that's doing the opposite. One man's trash is another man's treasure. And so there's always a treasure somewhere in the market. For me as a commodities trader, not so much this year, although unless you're in the metals, but for the last couple of years, it's been so much fun to find commodities that were really trashed, that were starting to run while other things were selling off. And so you just have to, once you understand how to look for these phases and you can scan for them, and we have tools for that too, by the way. marketgauge's been around for a while, so we got it all. We have a whole system where it tells you when something is changing phases. So you can see, oh, wow, this just went from a bearish phase to a recuperation phase, and we can get to that. So you can find those things and ignore the things that are selling off.
Yeah, yeah. So earlier you said you like to look for trades when there's a change in the phase. Do you find that I think you said the caution phase was after the bull phase?
Yeah.
Do you find a lot of retracements happen in that caution area, or is that just something you should avoid to initiate long trades?
You know, when you look at the wheel of the phases, it goes in clockwise fashion, but that doesn't mean the market goes in a clockwise fashion. Wouldn't that be wonderful if it just, oh, wow, here's the cycle. It goes from bullish, caution, distribution, bearish, recuperation, accumulation. No, you often get jumps. So there's a couple of things I've really discovered about that. Number one is, you get these fake phase changes. Something goes into caution. And like I said, it could be something simple like, I don't know, some news story came out, a downgrade or whatever, if it's a stock. And then it sells off quickly because you always have weaker longs in the market. You always have people who buy the top. So when you get a lot of people or that sentiment where, it's extreme bullishness, that's not going to sustain. So you might get a fake out. And that can go back to bullish at some point. I mean, if I had a chart ingrained in my head where we could look at that example, it would be easier. But yes, you can get the fake outs. But here's the thing. This is what I've discovered, is if you are in a bullish phase and it goes caution, bullish, caution, bullish, caution, bullish, caution, generally what that tells you is A, it's choppy, but B, it's choppy because something bigger is coming. Either it's signaling the top, but you still have those diehard bulls coming in there, or it's been, shaking out, and then the good news piece will come out, like an earnings, let's say, and it's going to shoot right back and to make new highs. It just means you don't know exactly what, but it's maybe time to pay attention because it's telling you that this choppy action is going to lead to something probably with a little more follow through.
Yeah. Okay. Yeah, that makes sense. So, thanks for explaining that. So, what about then the short side or the bearish phases?
Well, okay. So the bearish phases, I say I like. I mean, obviously, nobody really likes a bear market. But if I'm looking at individual instruments, I pay a lot of attention to things that have been in bearish phases for a very long time. I mean, occasionally you just get a company that's just, gone to shit and, it's been a bearish phase because it's probably going to go out of business. But not most things, and particularly not commodities. We know commodities that you're never going to not need natural, I shouldn't say never. I mean, obviously technology, they say, well, one day replace everything. But for now, you can assume that raw materials in bear phases will eventually come back for whatever reason. There's a host of reasons. This is what I'm really a student of after being a commodities trader for so long. Those reasons could be geopolitical, it could be weather related, it could be the producers basically stopped producing because the prices were so cheap, and then there's a supply chain issue, on and on and on. Obviously, COVID was like the textbook of commodities that were so hammered before and then skyrocketed because there just wasn't enough of them when people needed them, number one, and number two is there was no way to get them, right? So I'm putting context on this because I want people to understand the phases are so important. And again, with commodities, but also with certain stocks, those phases mean at some point they're going to come to an end. And that's where I lick my chops, is really my favorite phase is now you have the 50 under the 200. So let's go back to our visual in our mind. The 50-day moving average or the 50 weekly is below the 200. Price has been below. Slope is down. And maybe you're going to start to see the 50-day moving average now getting closer to the 200. Maybe you're going to start to see that negative slope flatten a little. And the 50-day moving average slope is always going to happen before a 200-day because it's 50 days as opposed to 200, so things happen faster, right? So if that 50 starts to flatten out and the price starts to get up above that 50, and I like to look for like a 2-day confirmation, I'm excited. That is the recovery or the recuperation phase. So what that tells me is that it's very, very more than likely that the instrument that you're trading has bottomed out. So when you hear people talking about this is bottomed out, I always wonder, what are they basing that on? And if it's, I immediately will go and look at the phase. That's my absolute favorite time to put on a position, because once people get wind of something bottoming out, you're already in, and now the masses come in. So while everybody else is figuring it out, you're sitting there collecting the money, as they say. Number one. And number two, if you're wrong, and it happens, you know right away that, it was a fake out, a little short covering rally or what have you, and it breaks back down under the 50, you just get out and walk away. Now, let's assume, Andrew, that you're right. And now the 50, the price is above the 50, but the 200 is still above the 50, right? Because it's bottomed out, but it hasn't gotten anywhere near a bullish phase yet. There's a middle phase. After recovery, there is an accumulation phase. And that is when now the 50 is still below the 200, but the price pops over, over the 200-day moving average. Now you know, just like those institutional sellers under a 200, institutional buyers are coming in over the 200. And you've already been long from a recuperation phase, so you're feeling pretty good. And you may even add now on that accumulation phase because you're getting another surge opposite of distribution, accumulation of cash coming in. And then sometimes that can just be the end of it and it breaks down again and that's the end, but you've had a nice move. And if you're going to find something really, really great that has bottomed, then eventually that 50-day moving average is going to continue to move up closer to the 200, and you'll get the opposite of a death cross. You get the golden cross, and now you're back into a bullish phase. Circle.
So simple the way you explained it.
It is simple.
Yeah, I think you raise a good point there about trying to pick bottoms, I guess, and there can be false signals, I guess. I assume you don't just buy because of the moving averages and the price cross in the direction. So are there other clues that you're looking for to try and determine if it's actually like a genuine bottom or maybe just a temporary?
Well, this is a very good question, because this is where my we created we created the real motion indicator, which is a momentum indicator at marketgauge years and years ago. But I was a little slow on the uptick to figure out how important it was, because as a floor trader, you didn't have to think about momentum. It was, you could see it, you could feel it, you could hear it, you could taste it, right? You could smell it. We don't have to go there. So I missed that piece. So I might buy something but the momentum wasn't there. Now, some people will look at volume, some people will look at MACD. These are, some people are mean reversion traders. This is all good. But I like when all the boxes are checked. So here's where the boxes get checked for me. Number one is I like to look for some kind of a blow off, right? So a blow off bottom. So a blow off bottom would be, like volume has surged. And it's almost like everybody and their brother now is out of that particular instrument or has actually turned bearish. And then you see that reversal bottom happen. But that's one thing. And then you're going to see the mean reversion people coming out saying there was a mean reversion. But if we see a long period of consolidation, I'm okay with that too, as long as now I see it on my momentum indicator. So I have to see that the momentum has also bottomed out, or even better, is showing a bullish divergence to the price action. Okay, so what do I mean by that? In the brilliance of Jeff and Keith, who created this instrument, they use a 50 and a 200-day moving average for momentum as well, with a series of dots. And if those dots cross the 50, or the 50 crosses over the 200 while we're in this bear phase, it gives you an aha moment that the momentum is shifting. And then you look for the price confirmation. And if you have the price confirmation along with the momentum bullish divergence, sometimes price happens before momentum, sometimes momentum happens before price. But if if they both confirm each other, it's a very high probability trade to take to make money.
Right. Right. Okay. And do you use the exact same logic for a top, or is there some nuance to that?
Top, like, okay, here's another classic example. So while everybody was talking about SPY lately, once it was getting over 5,600, it's going to 6,000, it's going to 6,000. It hadn't broken down under any major moving averages yet because obviously the SPY was so up. But the momentum indicator, the 50 was above the 200 in the momentum indicator, but the dots could not get through the 50 while the SPY was soaring. So even if you missed the last, $50 of the SPY move up, because I saw that the momentum was waning. And once I saw the momentum was waning, there was no reason for me to stop buying anything because I know we were nearing the top. That could work. Sometimes, you'll see a mean reversion to the sell side too, like the momentum is breaking down, the price is sitting right on the 50, then the price breaks down on the 50, and that's a good short or at least a signal to get out.
Right. Okay. Do you only ever look at technical indicators, or do you also do you ever take into account like macroeconomic factors as well?
Absolutely. I'm all about the macro. It's interesting. The years I spent on the floor, there were certain macro environments that you knew. I mean, I was really, really, really lucky because I got to learn how to trade on the floor during the tremendous inflation period, and then the ensuing recession, and then the economic growth where commodities kind of started to filter out, and now we were looking at SPX and futures of the S&P 500 and the Dow. So I could see the news and how it fit. Do I believe that the technicals precede the fundamentals? Absolutely. But do I know that I can sniff out when the fundamentals or the macro picture is changing just by mere logic and obviously being old enough to have a lot of life experience? Yes. So that's why, you mentioned I was on the news a lot, because I'm really good at saying, let me think of a more recent example of, right before COVID, I mean, it was almost eerie. I was going on and there was even articles that I was being interviewed for where people said, I said the commodities to the equities ratio was unsustainable, historic 100-year low. It was and something was going to happen, something that was going to create chaos for the commodities to go up and the equities to go down. And then voila, COVID. Now, would I have ever guessed COVID? Of course not in a million years. But now if we fast forward, the fact that you can see countries going more anti-global, civil unrest in countries, the tremendous $35 trillion of debt the U.S. has, and on and on and on, the political divide. It doesn't take a genius to figure out that this might create some impact somewhere in the market. And then my experience will tell me, this is a good time to look at gold. This is a good time to, tech was really doing well during COVID, obviously, because everybody was home. It becomes more instinctive than being a macroeconomic expert. It's unnecessary. By the way, economists, and sorry if I offend any economists, are usually the worst traders because they have no timing skills whatsoever.
Right. Okay. So do you think, a lot of you get this kind of, thesis about macroeconomic, where it could be going, and then you look at charts to try and confirm that? Is that sort of the approach you're talking about?
Yeah, like every year I write an outlook for the year, and I include my macroeconomic picture for the year. So coming into this year, you could see the patterns of what was going on. I mean, we still had the Russia-Ukraine situation at that point. Coming in, you knew this was going to be an election year. But I could also see the populism trend, and then you start thinking, okay, what are these trends going to do for the market? I'm not interested in just talking politics or geopolitics. For that, I'm always interested in what are the signs that it's actually growing and becoming a problem, or resolving and becoming a less of a problem, that we see the signs in the market. So I kind of mix it up. And sometimes all I have to do is look at the market, and then I just have to do research and see what's going on to maybe, why is gold going up so much? I mean, there's got to be some reason, right? So I anticipated gold was going to go up because I could see that there was more chaos happening throughout the world, and that countries that were pissed off at the U.S. because of things being very expensive and priced in dollars would possibly want to try to get more into gold as a reserve currency, which has happened, not BRICS, but, kind of like China accumulating, selling our treasuries. These are the kinds of things here where it's almost like, oh, gold looks like it can go up. Technically, here are the reasons why. And then when it's in, I sound like a genius when I talk about, well, yeah, China's been accumulating because they're selling treasuries because, right now our tariffs are killing, they hate us, maybe. You know what I mean? It's a dance. It's a dance.
Yeah, I think, some of those macroeconomic factors you just mentioned there also come from experience or seeing similar things that have happened in the past. And, you've been in the industry for a very long time and you've got a lot of experience. Is there anything you've seen historically that is kind of parallels to what we're seeing today? And yeah.
Well, I came into this year thinking that we might see a super cycle of commodities because the 70s looked very similar to what we've seen since COVID. Of course, everything is accelerated in time, and speed of everything has just gone crazy. So what happened in 10 years happens in 3 years now. But, social media, electronic trading, exposure to trading, blah, 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 all of that are the reasons. But I thought, because oil was such a powder keg in the 70s after the Yom Kippur Wars, and then the oil embargo, and then the price of oil went crazy, and then they weren't sending oil here to this country. And then, you started to see inflation was starting to peak up. And I thought maybe we were going to get a second wave of that as we were getting into 2024, 2025, and even maybe ending in 2026. And that's not happening yet. But I have my eyes out there. I'm certainly not wishing for it, by the way. And this is not a situation where I want to be right, because it would be very damaging on many levels. I mean, not to mention, obviously, war being damaging and a horrible thing. But I'm still not 100% convinced. And so when I look at the 70s and the CPI, and I look at now in the CPI, we had that big spike of CPI in 75. We had that big spike of CPI in 2021. It went all the way down by 1977, back down into around the 2.5%. Now we have this big drop here in 2024, down to about 2.5%. And then by the time we got into the end of 78, 79, things went crazy again. So I'm not 100% sure that we've beaten inflation, because what we're seeing, all this stuff going on all over the place. I mean, look at what happened today. The Middle East situation is totally not resolved. And the more the West gets involved with these things, and this is not an opinion, this is just a fact, the more the Russia and China and the Saudis, and, they start to get like, how can we hurt the U.S.? So it may not necessarily be the classic ways that we saw in the 70s with oil embargo, because we have oil now. But it could be more currency related, it could be more cyber attack related, it could be more selling treasuries or not buying our treasuries. I mean, there are so many things that could drive inflation at a time when there are cracks, the debt being one of them, government spending being another, and of course, not to mention the geopolitical stuff, and then the freight rates, which continue to go up, not down. So it's kind of like we're at this weird place right now where everybody's like, you can relax, inflation's over. And I still have that chart in my head thinking, everybody got pretty complacent in 78. And then whammo. So we don't know. We don't know yet.
Yeah, it's an interesting period of time to see how all these things unfold, I guess. So one question I wanted to ask you before we start wrapping up for today is kind of along the lines of some of those risks that you just mentioned there. We've all heard the stats about how 90% of traders fail, or whatever the number is. I don't know, but very high failure rate in the industry. So to have someone of your level of expertise and length of success is kind of out of the norm when you look at it statistically. So what do you think are some of the keys that have really helped you to, I guess, survive in the industry long term?
Well, I don't trade with my emotions. That doesn't mean I don't have emotions when I trade. I mean, I get happy when I'm making money, and I get like, when I'm not. But that's not what drives the trade when I'm in the trade. And when I recognize that bubbling up, I'm old enough and been in this business long enough where I can step back and kind of review, why am I in this trade? And if I still like all the reasons I'm in the trade from when I got in, then I calm down. And that lack of emotion really helps. I mean, I don't have FOMO. That's the other emotion that I think I've seen a lot of people lose so much money. I hate to tell this story because I love this man so dearly, but the guy who is my manicurist, I mean, he told me 2 weeks ago, I got into NVIDIA, I got into Apple, I got into Amazon, and I got into Google. And I'm like, that's the top, that's the top. So I think that the other longevity is understanding that the public, the herd mentality is really great when you're in first, but it's not something you want to follow when the herd mentality keeps growing, because generally that means they're wrong. The public is wrong, just like you said before. So emotion is a huge part of it. I think that I really understand megatrends. I can see the things that will change society, whether it's in a very profound way, like AI, for example, or in not such a profound way, like improved gaming or 3D printing or, something like this. Once I see where things are trending, or even in fashion trending, or, environmental trending, or however it is, again, no opinion on whether I like it or don't like it. It's just I can see it happening, and I can get into those things and keep the emotions in check and be smart about it. That's been a real key for me, a real key for me. So and I'll end with this. I wrote an article today about Rivian. And I've been kind of thinking about Rivian longer term. So Rivian's trading at like $16 a share, and Tesla's trading like $220 a share. And we know that Tesla is more than just a car company. Obviously, it's software packages, and their self-driving cars will be, the thing of the future and all of that. But still, that's a huge disparity. And I'm starting to see more and more Rivians around. And in the first quarter, they actually did very, very well in terms of deliveries, even though the stock dropped. And so I'm watching the fundamentals, but I'm seeing a consumer instinct there. But ultimately, with Rivian, I have to have the technical signal, and I have to know what my risk is. And at some point, and even Zacks will say this, Rivian could be in 2026 a $100 stock, because they will figure out to make a sedan. They've already got one as a prototype. They will reduce the cost of their cars, because obviously not everybody can afford an $80,000 car. They will, the EV space, even though it's taken quite a hit this year, will figure it out. And maybe that's Elon's great achievement, is that he actually helps with the infrastructure of it all. So that's a trend, right? So instead of just like getting long for solar, because that's been so fluctuating all around, I'll pick that company because I do believe it's the number 2 EV in the United States. And if we have tariffs, then that could be a very good boon for Rivian. And both candidates are talking tariffs.
Yes.
And we know Europe already implemented EV tariffs with China. So, if I put that all together in my head, that doesn't mean I'm already long in Rivian like today, but it means that will be a position I will establish when I think either A, momentum has shown me the way. The risk isn't too bad. And I can see now that those phases are in gear, and I may even look at a weekly phase as opposed to a daily phase because I want to be longer term. And that's how I operate. So if I see little dips here and there, I will not be that concerned.
Yep. Okay, well, thank you very much for that, Mish. That's a really nice way to end our discussion today. So if people wanted to get in touch with you or learn more from you, where can they go?
Well, first of all, I am very active on X. I mean, people say to me, well, if you're that good and you're that smart and you've traded that long and you've done so well. I mean, you can see I have a nice room behind me. I've collected a lot of art. We've lived a great lifestyle. Then why do you want to teach my sorry ass? I mean, really, I've literally gotten that question. So, and don't forget, I started out life as a teacher. I also have such compassion for people. I hate to see people blow up. I hated it on the floor, and I hate it when I see it on X, and I hate that people follow people that don't really know what they're doing. This is to me, I have the time to do it, so I'm happy to do it. I know that's a long answer to your question, but I really think it's important that there are many people like me, by the way. I'm not unique. There are so many people, and I could rattle off a few names just off the top of my head, who do spend time trying to help people legitimately, even though they themselves are very successful. Maybe I'll get to an age at some point where I'm like, oh, I just want to travel and forget social media, but I'm not there yet. So Market Minute is my X handle. Market Gauge is our website, as you have shown up there on your screen. And my daily, Mish's Market Minute Daily, like I said, I just wrote the one on Rivian. I often put my ideas there. And if you go to the media page, all my media hits are there, including this podcast that we did today. It's not too hard to find me. I'm on LinkedIn. I'm on Instagram. I'm all over the place. So
everywhere, yeah.
I'm everywhere. Just Google me.
Yeah, that's right. And what I might actually do, Mish, is I'll have a chat to you offline and see if I can get some links to some of the things you mentioned today, because I think you said something about a wheel. I don't know if that's publicly available or not. And I'll also put some links to some of the YouTube videos, which I watched a few, which I think would be helpful for everyone else. So if you're listening to this replay, then just look in the description box below the video on YouTube, and I'll have some links to some of Mish's stuff, and I'll include her other channels as well. So make that easy for you to find Mish if you don't like to search. So yeah, thanks a lot for the discussion today, Mish. I really enjoyed it. It went by so fast. I can't believe it's over already. Any closing thoughts before we wrap up?
Well, it's summer, so just respect the fact that you're going to get a lot of opinions about a massive correction or a massive rally. I mean, there's both sides. So I would just say that if you want to really stay in this game, the best thing for you to do, right, is to try to become an expert in one thing. You can grow from there, but it's always good to pick one thing and say, until I really master this, then I will move on. And that's a really good way to start. I was lucky. I mastered day trading of a commodity that I happened to be in the pit in. But that has been my foundation. And without that, I would never be sitting here talking to you today.
Yeah. Excellent. That's like a mic drop moment. So thank you very much for sharing that. What a way to end the show. Thanks for joining me today. And thanks everyone for watching the replay, and all the best.
Thank you so much, Andrew. And thank you, viewers.